Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting. Welcome to Charts and Chat for June 20th of 2022. Please see our disclaimer for important information. On our first slide of this week, we look at the basically the Global Fund Manager Survey from Bank of America. And this is part of essentially a consensus opinion amongst institutional managers on where they think the economy is going to go. And this is the global economy over the next 12 months. And so the feelings are pretty strong that we're going to hit stagflation across the globe. And that just means below trend growth and above trend inflation. Not too surprising, but that this number continues to be reinforced with each successive week. On this slide, we have from Charlie Bolello in his Twitter feed. Basically, he goes back over the last 8 bear markets, and the interesting thing about where we are today versus the other 7 is that in the other 7 we had what we call this Fed put, which just means a put option just means it protects you if you own it if the market goes down. Well, the theory goes that the Fed would step in and reduce rates to help accommodate investor sentiment, which would be fairly obviously damaged in a bear market. Well, this is the last time that we had an environment like we have today was actually in the early 1980s when Fed Chairman Volcker stepped in, and after a period of significantly high inflation, he came in and was very aggressive on increasing rates, and that's where we are now. So with the market going down, don't expect any favors from the Fed. Here's a Conference Board index of leading economic indicators, which we have watched for some time now. And what's interesting is that you look at this time series. This goes back to 2016, and you can see where the indicators were beginning to erode even before the pandemic. And obviously the pandemic changed everything for a while, and they went back up. And then we've had this steady kind of trend and then this erosion here lately. And so the last time that we have seen 3 consecutive negative prints for this particular indicator, was actually back in, frankly, 2019. And then again, right around the pandemic. And so we haven't seen this in a while. And, it's kind of reinforcing this economic slowdown that is being inspired by not only the economy, higher inflation, but also eventually and essentially what the Fed is doing right now. Here's a consensus forecast by Wells Fargo, which I think captures the consensus here on the trends in real GDP growth. And so this is economic growth. Obviously, we've had a negative quarter, and we look at the forecast, and they're actually somewhat robust. I think maybe a little bit too much so. We've got in that red line represents a year-over-year percentage change, which over a period of time, you can see that downtrend. You can see in the aggregate, the estimates for each quarter successive heading into 2023. We see that that's slowing down. And then the consensus forecast is that we do have a full-out recession in 2023. Now, the question is, how mild is it going to be if it comes? There's some people, and I think there's maybe a 20% chance that we might be in a recession right now. I think as we get a little bit closer to July, we've got about another month and a half before we hear the first revision, or the first iteration, I should say, of second quarter gross domestic product, basically April through June. And we might see these estimates come down just a little bit, and I think in some sense it'd be good for sentiment if it did, so that we try to align the consensus estimates with kind of what we're seeing in reality. And we are seeing economic data points begin to churn down a little bit. Here's financial conditions. No surprise here. This continues to trend down here during the year 2022. Bloomberg News stories and these are interesting to watch sometimes. And this is essentially a story count. So it's a word count within stories that are published. Financial news, the mentions of job cuts, layoffs, and things like that. It's beginning to pick up now. So there's more mentions of layoffs beginning to hit the financial press right now. And sometimes, and we've seen this in the past, where generally when you hear these types of pronouncements, you tend to see them follow a little bit. So with the tight labor market that we've got right now, we'll see this in a second in Philly Fed, that we are probably going to see a little bit of tempering in the labor market, which is actually a welcome sight, because we have a relatively strong labor market, and the Fed has a dual mandate to want to control, maintain price stability as well as full employment. Well, we've had very full employment, and it's only natural to think when the Fed starts to attack inflation that it's going to impact the labor market as well. Here is a plot of the Fed funds target rate. We know that we have been moving up. We had 75 basis points this past week. I think it was expected to be only about a half percentage point for quite a while, and the Fed had basically telegraphed that. And with the inflation reading that we had a bit over a week ago, I think that solidified the consensus thinking that we're going to get a full 75 basis points, or 0.75% increase. So you see that in the amber line here. The blue line represents this median band of longer term expectations. And they derive this from the dot plot, which is this forward estimate by all the Federal Reserve Board, Open Market Committee members on what they think. And these are compiled, and this is the average of that. And so what's interesting here is that we're at 1.75 on Fed funds target rate right now, but that's becoming a lot closer to this 2.5% target that is firmly embedded and has been for quite some time in the long run target for Fed governors. Quick look at gas prices. This is the national average. We're about $5.11 per gallon. You can see that trajectory increasing at a rapid point. I think it probably still has some upward movement to go, especially as we are in the midst of the peak driving season for summer. A lot of people taking vacations. Wouldn't be surprised to see that continue to move higher by another 15, 20 cents perhaps. Then you really, by all estimates that I've seen, the demand destruction begins to filter in when you get to about $5.50 to $6 a gallon. And that's when people really start to ponder, well, does it make sense to make a cross-country trip, or does it make sense to, if I can work from home and I've got the option to work from home versus going into the office, of just simply doing that. Here's housing starts. Now, we did see a rather dramatic decrease in housing starts, and month supply continues to move up a little bit higher. Now, if you look at this trend line, I mean, we're still, relatively well within this long-term, loosely, line of best fit. If you go way back to 1960. So it's not like things have completely fallen off a table, but clearly there are some supply chain issues, and then if housing affordability is getting a little bit more difficult, and we see this in builder sentiment. They're still optimistic, but it's off a little bit, and we see housing starts not just in single family, but also in multifamily. Kind of look a little bit sluggish. And we know that permits are looking a little bit sluggish right now as well. Now, here's some of the information I was foreshadowing earlier. It's a Philly Fed Business Outlook Survey, and this is a diffusion index. So anything below 0, anything negative essentially represents feelings of contraction. And so the blue line, we see that number is now negative 3.3. So the Philly Fed Business Outlook Survey is now foreshadowing contraction. And then we see that in the Business Outlook Survey, number of employees, which has this line of best fit. This was actually in a Twitter, or in a tweet from Liz Ann Saunders of Charles Schwab, and I thought it was really interesting because this has these two data series have really strong relationship with one another, and so this also seems to corroborate the notion that we're going to have some weakness emerge in the labor situation. You see that amber line. This is number of employees, and we'll see this again here in a second, directly in the Philly Fed survey. So in the Philly Fed data that came out this week, again, this is just one regional survey coming from one of the 12 Federal Reserve banks in the country, and so we have expected new orders trailing off. This is for manufacturing, and then this number that we mentioned in the last slide, number of employees. This is expected number of employees, so it's not just current trends, but this is the expectation. So clearly that is still positive, but it's moving lower. And so again, just to the point, as we see, we'll see Kansas City, we'll see some of these other we'll see Chicago, we'll see several of these extremely well monitored regional sets of data, and I think we'll see consistency in these two particular aspects. Here's manufacturing unfilled orders as well as expected delivery time. So if you're going to draw a silver lining from all of this, what's clear here is that, at least for manufactured goods, we see some demand destruction, some demand decrease in these, and that has helped to clear up some of the supply chain issues. So while they haven't gone away, obviously the number of unfilled orders is moving negative. So that's obviously manufacturers are able to support a greater percentage of the lower level of demand that they're seeing, and then delivery times are also going down as well. And here's the relationship between the Philly Fed and the ISM, Institute for Supply Management Manufacturing Index. And so when I say that the Philly Fed, in some sense is a microcosm of that particular district. Now the Philly Fed survey is just for the Philadelphia Federal Reserve District, companies in that district. And so the ISM number is national. And so when I say that there's some comparability or maybe portability of some of the signals that we're seeing out of Philly Fed across the country, this is what I'm talking about. You can see here that you've got Philly Fed in red, and then you've got the Institute for Supply Management Manufacturing Survey overlaid in the darker color. And so what you see here is that more than likely nationally we're going to see that ISM number follow Philly Fed a little bit lower. Here is the Producer Price Index, finished goods index, and so we did have a PPI number that followed CPI, and obviously it was high and continues to tell us that there is inflation in the producer channel, and we can see that here. PPI finished goods well ahead of recent trends over many years. Now, with regard to housing, and we talked about that in the builder sentiment and whatnot earlier, here's the 30-year fixed mortgage rate from Freddie Mac, and it's 5.78, and this is the 30-year conforming fixed rate, and you can see that we haven't seen a rise of this magnitude in a long time, and we're at levels now that we haven't seen since 2008, frankly. Here's the National Association of Home Builders current single-family sales, and what we were alluding to earlier is that the housing industry is kind of hitting a little bit of an air pocket here, and you can see that that blue line is trending down a little bit. And so single-family housing starts has also trended down. It's at a high level, and has been at a high level for quite some time now. So, and to be fair, so is sales. It's just that the froth and the oxygen that has propelled these this particular part of the economy and fueled the intense energy and rise and whatnot, it's beginning to soften up now. And so this, I think, leads us to this conclusion that home prices will not accelerate at the rate that they have, and maybe they continue to move slightly higher, particularly in some markets. And I would say certainly in the local markets, in our market here in the Austin, Texas area, where you have a considerable amount of underbuilding that you're still trying to catch up on from the last 10 years. And you also have a lot of net migration from people that have moved here or want to move here because of job relocations. Well, this is the ugliest slide in the pack. I know many of you out there are playing in the Bitcoin and the cryptocurrency space. The one thing I can offer is that there was a lot of froth in that market, and I know, cryptocurrencies like Luna and some like that have just basically been wiped off the map. But I had a chance to visit with U.S. Senator Cynthia Lummis, who is co-authoring a very strong bipartisan bill with Senator Kirsten Gillibrand of New York to provide some much needed regulatory overlay into the cryptocurrency market. And I think as that happens, you'll see some cryptocurrencies kind of rise to the top and perhaps become maybe a little bit more stable. Obviously, this is very symptomatic of instability and is a big reason why you don't see a lot of conversation, even less so now, about Bitcoin being a store of value. It really is an asset and a very speculative asset at that. Here's a chart of commodities, and you've got two data series here. You've got one in the black, which is basically the Bloomberg Commodities Index. You can see that moving higher. This data series goes back to January of 2020, so you can see the impact of the pandemic and the resulting uptrend. And I think that uptrend continues. Now in the amber, you see the Goldman Sachs Commodity Sensitive Stock Index. And so obviously those companies that are in the commodity industry as manufacturers of, like, say, industrial wire, or people that are doing aggregates, or people that are fabricating metals, or lumber suppliers, all those folks are doing somewhat well, even though the market has taken a little bit of a chip off that. But you can see it's a decent but not exceptionally strong relationship. There are ebbs and flows, but I think the trend is still generally up. Here's a chart of commodities versus stocks. And so basically you see in the black, you see the standard S&P 500 versus the basically the commodity index. And this is, you can see the relative strength of stocks versus commodities over a long period of time, very long period of time. In fact, this data series goes back to 1870. But you can see the oscillation down below in this blue that oscillates the difference, basically the difference between the S&P 500 and the commodity index in terms of 10-year compounded average returns. And it's a long-winded way of saying when you see this at a high point, and the last time we saw this was like in 1998, 2000, and generally when you see something that high, or essentially where we are now, we're trending down below. That usually indicates that we're heading into some people call it a commodity super cycle. I tend to call it maybe a period of relative outperformance by commodities, and as a result, we've taken a higher profile in commodities here as of late. Gold and real rates. And so this is a bit of a busy chart, but what I'll tell you is here in you've got in the black line you've got gold, and gold is kind of holding in a range and has for really since the beginning of the pandemic, I call it. So we saw a peak of about $2,075 per ounce. Now we're about 1870, 75-ish. Now what's interesting is if you map that to real rates, right? And so we see in the amber shaded set of bars around the midline there, you see that is the 10-year yield minus the 1-year core personal consumption expenditures index. So that's basically a real yield. And you see that, obviously with inflation running higher, that number's been significantly negative. And so that tends to propel gold. In fact, it would suggest, based on the negative real rates that we've seen, that gold should have been much higher than it was. And consequently, in the blue shaded areas, so that's basically the 10-year tips real yield. And so that's been pretty negative. And so that has also suggested higher gold prices. But what's really interesting now is we've seen the rise in yields to correspond with that inflation. And so in some cases, we're now witnessing, an inflection point where, maybe we're not in positive real yield territory, but we're getting a lot better. And so that would tend to suggest that gold has a lot farther to fall than where we are now. But the interesting thing is it continues to hold up very well. Here's a chart from JP Morgan, the S&P 500. You can see this chart going back to 96 and the ebbs and flows. And, as we say, markets are inherently cyclical, and you can see the very well-defined cycles here. And again, we went back to the global financial crisis. It took a pandemic to end that super long cycle that we've had. So right now, basically as of the close of business Thursday, our PE ratio in the market was about 15.8. Dividend yield was about 1.8%, and the 10-year treasury was about 3.3%. And you can see on this chart where we've come down significantly off of our high. So essentially, we're down about 23% from our peak. But you can see if you go back to basically right before the shutdown, we were at 19 times earnings on our PE ratio, or dividend yields maybe slightly higher, but our 10-year treasury was essentially less than half of where it is now. And then, you can see on this chart, if you go back to 2007, before the global financial crisis, the market multiple was about 15 times, and the dividend yield was about where it is now, maybe a little higher, and the 10-year treasury was higher than it is now. But you see here just, in relative terms, I'd argue that the market is certainly not expensive. It is perhaps a little cheaper than our long-term averages with this pullback, but it's not outright inexpensive at this juncture. Here's a quick chart showing you the progression of analyst estimates for the S&P 500. And these are estimates of where the index is going to end up. So you see the index itself in the amber line, and then above that in the blue you see the analyst expectations, the strategists, if you will, and where they expect. And so we're kind of having what Liz Ann Saunders at Schwab calls kind of a catch down. So you see that blue line is significantly higher than where the market is right now. We're below 30. Well, this is perhaps this is on the 15th. So we had another downdraft on the 16th, so it's actually lower. But you can see that there's a significant jump or difference between where the market is now and where analysts expect it to be by the end of the year. Well, I thought this was interesting, and from LPL research, and it's a summary of what stocks do after we hit this bear market. You know, a lot has been made of, okay, we're here, we're getting rate increases, we've got inflation, things are slowing down, we've hit the bear market finally. So, what happens from here? Well, obviously, we can't say with any certainty, but if you go back and look at, since 1950, we've got, S&P index performance after going into a bear market. And you see that, that basically if you see stocks going into a bear market, you're already well entrenched, in many cases, in the slowdown, and you tend to have better index performance heading out of it. Now, there were some notable exceptions. Obviously, in 1970, 3 and 6 months later, you were still negative, but you were positive a year after that. In 1973, we had the issue with OPEC and the embargo, and we had a significant amount of commodity price inflation as a result of that. And so that did put a lot of pressure on the markets a year out. And then in these other cases, obviously it was positive. You can see here in the green, but 2001, that was a very shallow recession. It was a terrible market, but it was a relatively shallow recession. And then 2008 obviously was a global financial crisis, and so we did see, once you got past really 2000, March and April of 2009, the market really began to take off and actually recover significantly. Now the market in 2007, 2008, primarily 2008, was down really, a major significant amount, to where even looking at this a year later, it was still down 29%. But we've frankly had a phenomenal year in 2009 in the aggregate. And then 2020 obviously was a shutdown. You could see that more often than not, you do have positive performance after we hit a bear market. This I thought was interesting from the Russell 3000. It's the number of members in the index with a market cap less than their cash. This means that these stocks are trading for less than the cash that they have on their balance sheet. And while it's not a strong number, it's maybe 4%. Obviously you don't see this too often. And this is symptomatic of, in some cases, just a literal fire sale where, people are looking to get rid of everything. And what's interesting here is, this is Russell 3000 is primarily smaller capitalization stocks, and their multiples are actually very cheap. I mean, they're below 11 times earnings, so they're very cheap. They just need a catalyst, and you can see here that there are even some of those that are trading less than what they have in cash on the balance sheet. Now we'll talk about the S&P 500 PE ratio, and we've kind of talked and hinted and kind of discussed the fact that the PE ratio has come down quite a bit. And you can see in this chart in the blue, this represents the percentage downdraft, if you will, in the forward PE. And so we've had, since the beginning of this downturn, we've had a drop of 32%. Call it, let's just say, in other words, that the PE ratio of the market has dropped by a full third in this downturn. Now, will it go further? We'll kind of explore that in just a second, but you can see that it went down 32% in the shutdown, the pandemic. It also went down about 28%. We had, we had a significant market downturn in 2018, just before 2019. And then, you see historically, we've seen some major downdrafts, and you see that January, or at the end of 2008, we had a 42% drawdown, a major reset and repricing of stocks. But, we've drawn down quite a bit. Here's our S&P 500 valuation measure, again, from JP Morgan. You can see here, again, the PE ratio is dropping, depending on what type of adjustments you're using on your earnings, the multiple right now is anywhere between like 15.5 and 15.8 right now. And you can see how much that has dropped. As we just saw, it's dropped basically by 32%. But the 25-year average is over 16. And so, when I say the stocks are certainly cheaper, that's absolutely true. Now, are they fairly valued? Well, maybe, given the current level of earnings, if your yardstick is this 25-year average. Can the multiples go lower? Yes, but I think the risk to this particular analysis right now is really not valuations, it's earnings. So you could have valuations remain static and earnings go down, and you'd actually have your multiples go back up again. I think the most likely case is that you see stocks continue to re-rate here, which just means that the PE ratios are going to be below average while we're trying to fight inflation and get our sense of where we're going to be able to, are we going to be able to have a mild recession? Can we engineer that and then resume a new cyclical period of growth? Or is it going to be a harder landing? And in that type of scenario, I'd see the potential for stock valuations to go lower. But if they go another to that bottom dotted line, which is a full mathematically, it's a standard deviation away, and that's a pretty significant line. You see that in the global financial crisis, we did that, and we kind of bounced around that level, but it led to a significant prolonged period of growth in multiples that were also helped by earnings, pushing those multiples even higher. And I think that might be the case for us as we look out into 2024, 2025, 2026. Here we have profit margins, and so this is where I was going in the prior slide. When you look at profit margins, as you see on the left-hand side, these are operating earnings divided by sales. So you can see that ratio is moving higher, and we were at various points flirting with all-time highs. Well, we know profits are coming down. They were around 13% at their peak. Now they're about 11.9, 12%, and could be moving lower. And I do think that that's going to be pressuring earnings to some degree. Now, if you look on the right-hand side, which I thought was particularly interesting on this slide, you have labor's share of income and profit margins. So in the green line, you see the profit margins in the aggregate, and then in the black line, you see essentially labor's component of that. And you see labor accounts for about 55% of profit margins. And so that's when I say when we have higher wage costs in a tight labor market, that tends to put pressure on margins. It seems pretty intuitive, but the one thing that could help that is if we see some slowing or slightly lower momentum in the labor market, which may be coming actually, and we saw that earlier. If that comes, then maybe the labor component of this eases off, and then maybe profit margins don't fall so much. And if that's the case, the market will react positively to that. And if we can control overall inflation and kind of have demand settle out at a level which perhaps could begin to build a new base, then that would obviously bode well over the long haul for stocks. S&P operating margin, as we kind of dig into this a little bit, this will corroborate what we just saw, that the correlation to inflation on the S&P operating margin side, you can see employment cost index, average hourly earnings are clearly the most important contributors into operating margins. This from Gina Martin Adams. This is she is a technical strategist, and I've followed her for quite some time. Basically, she looks at these technical indicators, and it looked like from her standpoint that we were close to forming a bottom in this market based on her analysis with the decline we had on Monday. And of course, we had subsequent drops later on in the week and ended the week on negative territory. But we didn't have a momentum indicator that would help to basically what they call it confirming the technical indicators. So we're not quite there yet, but you're beginning to see these technical analysts that are watching the movements and the relative strength and these moving averages begin to talk about getting closer to a base where we can again begin to find some footing in the market. And then I'll end on this one. We do talk about in many respects, over long-term demographics and fertility rates going down. And, I saw this, actually, this actually came from a tweet on the left-hand side from the Wall Street from Elon Musk and his Twitter feed, and then I found some research later on talking about the global fertility rates. And I thought it was pretty interesting and a good slide to end on. Obviously, in the U.S., you can see fertility rates are moving down. We're about 1.8 now. Back in 1989, we're basically 2.01, which is the replacement level. And we were there as recently as about 2008, but fertility rates have been moving down ever since. Now, if you go back over to and look at the global number, and that pink line represents the global number, you can see that back in 1950, fertility rates were much, much higher. And so basically, the average woman had 5 children, if you can believe that. But now that has gone down, basically been cut in half, and it's represented in most developed areas, and certainly in emerging markets as well. That's all we have for this week. I hope you've enjoyed the chart pack, and look forward to seeing you again soon. Take care. Bye.